Well, that's yet another week where we mess up the intro. The boys are
So
back
much for
in
theme
town.
music.
Nice to see you put on the hat right during the intro section there, Jason. Thank you for doing that. Giving us a taste of Derby Man. Ladies and gentlemen, this is the Pirates of Finance, where I guess we got to reset the week counter for yet another week of technical issues. But at least we're here. It's nice to be here. Sorry if you missed us last week. A little bit of confusion. Jason was at the Kentucky Derby and couldn't be bothered to get his phone out and record. Is insulting to all of us, which I'm just as mad as the rest of the booty crew. But for those of you who are maybe tuning in for the first time and have no idea what this show is, well, this is the Pirates of Finance. We're your hosts. The incredibly handsome man sitting across from me with the old Western hat, looking like some sort of old Western bank robber, is the young Hemingway Jason Buck. I am in the inferior co-host, Corey Hoffstein, and this is a show that's about nothing, honestly, at this point. It's supposed to be about finance. It's supposed to be about us making fun of macroeconomics, I guess. Markets, business, anything we think about, most of the time it ends up going nowhere. Today, I want to start off with a deep admission as to how dumb I am, Jason.
Well, before you get to how dumb you are, you actually even forgot to say, like, nothing we say is investment advice, because obviously we're two idiots on YouTube on a Friday live. So seek out your own professional investment advice. And yeah, we can get to how dumb you are. But one of my favorite things is like all like Southern sayings and everything. But have you ever heard the rancher saying that he's all hat, no cattle?
Yeah, that's a great one.
That's what I just feel like whenever I have this hat on now.
All hat, no cattle.
All hat, no cattle.
I love it.
So we both been
notice the subtle brand in it though, because you got the nice logo in there.
Yeah. Some people noticed like right away. Other people had no idea. It was like, somebody right away was like,
tell me the process of getting that hat, because that's a pretty sweet hat.
Shout out to a friend of mine, Drew Knowles, hooked me up with Montana Territory Hat Company. And she makes hats out of Bozeman, Montana by hand. And so it was an interesting process. You kind of like choose your style, everything you want. And then you could add all these little, twists to it. Like most people will, on the brim and everything, like they'll create, crystals, feathers, whatever they want. I'm not sure my camera's going to pick this up, but like what you were referencing is I put our Mutiny logo. I had it burned into the hat on the side. And then on the back, I have under the brim, I have moar burned into there. So yeah, just add in some little twists to it to kind of make it my own. But it took a few weeks to have it made, and luckily I got it the day before the Kentucky Derby, so I was actually able to take it to the Derby.
As a man who only gives himself a limited amount of clothing to work with, did you have to get rid of a hat to allow yourself to have this hat?
Yeah, the other like the open road style I have from Gladys Thomas. Yeah, I got to think about what I'm going to do, right? Because that's two kind of hats that require almost like hat boxes, or obviously when I just travel, I just wear it while I'm on the plane for ease of use, because as you know, I only have 2 carry-on bags. So yeah, I don't know what I'm going to do. I'm probably gonna have to get rid of maybe the Gladys Thomas hat and use this bespoke one moving forward.
So I guess this is a haberdashery podcast now. All right, let's move on to some real stuff. The real stuff being, I'm a moron. This will lead somewhere, I promise. But yours truly showed up to the airport Wednesday afternoon and tried to use his digital ticket on the phone to get through security, at which point they informed him that his ticket wasn't working. So I went to the desk agent and I said, hey, can you figure out what's going on with my ticket? At which point she pointed out that the flight I was trying to get on had left 2 hours before. I said, that doesn't make sense. It's my, why did it leave at 3? My ticket clearly says it's leaving at 5. And she said, well, that's because you're supposed to be flying out of an airport that was 8 hours away. So basically what happened is I was supposed to be flying from place A to place B on Wednesday and from place B to place A today, and somehow completely reverse those. So to make my meetings on Thursday, I had to, fortunately it was close enough to drive, but I had to jump in my car and do an 8.5-hour drive through the middle of nowhere, Florida. And this is where I'm going with this, Jason, is I drove through, and I don't want this to come off sounding judgmental. I want it to be like as objective as I can be. Some incredibly economically depressed areas. Towns that everything was shut down, that the only lights that were on were like a McDonald's and a gas station. And if you went into that gas station, there was a ton of activity in that gas station because it was the only thing that was there. And it made me sort of think about one, like part of my question that I was thinking to myself was, when did this happen? Was this a 2008 fallout? Was this a COVID fallout? Was this something else? It was a question that was going through my mind. Two, again, I always think when I'm in these areas, like, what do people do for a living in this area? And how do you escape this sort of area if you are trying to potentially do better for yourself economically? Not saying that you should have to escape that area, but if you want to do better for yourself economically, there's very limited opportunities in some of those areas. And then it made me sort of think about two other things. These are meandering thoughts, but these are road trip thoughts, so I think they're allowed to meander. One of them was one of these. One of the quotes I was hearing last week a lot was, "We're going to have a recession, but it's going to be a Wall Street recession, not a Main Street recession." That basically labor will stay strong, the average consumer will be fine, but in the way Wall Street recovered in the 2010s and Main Street didn't, you're going to have a reversal of that. That what interest rates gave to Wall Street in the 2010s, hiking interest rates will take away. It will mostly be a recession in asset prices and valuations. It will not hit most Main Street pockets, and those sort of people will be fine. The other thing it got me thinking about, though, is let's say that's not true. Where does the economy begin and where does it end? I was thinking about bullwhip effects and factory towns. Are they at the beginning or are they at the end of the economy in terms of who's in control? Who's actually having the profound influence? Is it bankers who are creating credit, that are creating, new businesses, that are creating jobs, that are creating money in the consumer's pocket? Or is it the consumer spending that creates the opportunity for new businesses and demand, and it works its way backwards? I don't think I have an answer for that. But again, when you're on a 16+ hour road trip, I think your mind wanders a bit. So those are all just random thoughts I had while driving through the absolute desolate countryside of Florida and the swamplands. Any thoughts?
So many things. One, are you trying to just drag us into a global macro? Yeah, exactly. Just drag us into a global macro idea. I just wanted
to, as I said, I'm exhausted, and so I just wanted to tee you up for a 20-minute rant.
Yeah. So you could take time and write emails. One, I was super jelly actually because I love road trip thoughts, right? Like when I was in like high school and college, we traveled out west like a bunch of times and did road trips like all summer, like save up money and then just went camping out west for like months at a time. And there's nothing like those long desolate roads for just kind of like road trip thoughts and like thinking about your life. And to your point, I actually almost had to do a 10-hour road trip the other day because our flights leaving the Kentucky Debry got delayed by 22 hours. As I texted you later in the week, I felt like I got quarried. But what I did notice though is like, you like to text me your entire saga while you're going through it. I just tell you like days later, oh yeah, I was delayed 22 hours. Just a difference in how we deal with the.
I like people to know my pain.
Yeah. So but like to your point, like so. Because there are so many things you brought up. Like one is like the idea, a concept of good set of luggage. Like if you want to leave that town, how do you leave that town? And thankfully, like the internet and mobile phones and everything, like you have an idea of a broader world out there. But more like when I was, growing up in the 80s and 90s, like that was, a little bit tougher to realize like what existed out there, what everything. Like I remember, I think a kid moved to our school in Michigan from like California, and I just assumed he was like the coolest surfer of all time and just knew all of like the pro surfers and everything. But he was probably from like Sacramento, right? Like it was just from somewhere, or the Inland Empire. But like we just had no clue back then, right? Because like television wasn't what it is now, nor the internet, all those sorts of things. the other question you brought up was like, do people want to leave those towns? I think it's interesting is the reverse diaspora of like going back to those smaller towns. And now with internet and Zoom culture, like you can carve out a niche like big fish, small pond kind of thing, if that's what you want to be around family. And, but as you know, driving through those Florida towns is like the Southeast historically has been the least mobile populace. So if you ever look at the data around like Thanksgiving, Mother's Day, etc., you will see an enormous amount of driving culture in the Southeast because they all live within a few hours of their relatives. And it's they've sustained more of that homogeneous family population within a relative range more than almost any other region of the country. And so, as you know, North Florida is really like the deep South. I wouldn't really count, you don't count Miami as the same as you would count like an Ocala. And so that's the way I think about it too, is it's more of that southeastern United States, and they tend to like prefer to be around family. The other thing, I don't know, this always boggles my mind is like historically how the northern versus more equatorial climates, how it just leads to different lifestyles, right? Like in New York City, you're going to work hard because, maybe 6+ months of the year, it sucks to go outside. Whereas if you live in, closer to the equator and fruit grows on trees and everything, and, you can go to the beach, it's like, why work so hard? So yeah, that's the also you might be seeing is like that gas station in those rural communities becomes like the community center. And that's what you're more seeing. And that's where everybody gets to hang out, get the local gossip and all those sorts
Yeah,
of
but
things.
I thought one of the things that was interesting, the thought that popped to mind was like the only things that still existed were these conglomerate backed businesses, right? It was the McDonald's, it was the Burger King, and I get that they're franchise businesses a lot, your Shell station or your mobile station, right? But you didn't have the mom and pop shops anymore, right? You needed something with more corporate global backing and global infrastructure to keep the costs down to survive in that town anymore.
Except for I'll push back a little bit. I bet when you stop at those corporate gas stations, they still have like a mom and pop like food service in there, right? Like you can
Yeah,
get
they did.
like
This morning,
there's almost like a restaurant inside of it. It's awesome.
so I got started really early this morning and ended up stopping at a gas station to grab a water like an hour and a half into my trip. And people were lined up for that mom and pop food shop. I saw these two kids who were probably on their way to school that walked in full camo, full mullets. It was real glory stuff. I was loving it. I was soaking it up. I will say I almost got myself a fried catfish sandwich for breakfast. And then I thought,
Nice.
better of being in a car with
You're
myself for that long.
you're already having a rough road trip. A nice
Yeah.
fried catfish sandwich. The other thing it reminded me of, though, that I'm sure you passed by, like, did you stop at any Cracker Barrels?
I did not.
Oh man,
I did
there's
not.
two things I love on a road trip: a good Cracker Barrel, and that's just for reminiscence sake. 'Cause one, I love cornbread. Two is back in the day, you could get your books on CD at like Cracker Barrels, and you could rent them. And so while you're on your road trip, you would rent it in one location, and then you return it.
What?
Yeah,
You get okay, I did not know that. I did see a lot of Waffle Houses. Those were pretty tempting. You don't get a lot of Waffle Houses in the north that I'm used to, so those are
yeah.
tempting. But I
And
will say I was
have you
actually
been
impressed.
have you been in the South, or do you live in the South if you don't go to Waffle House at like 2 a.m.?
That's
Like you'd have not
that's a
experienced Southern culture.
Yeah, look, I live in the urban South, I guess, at this point, which is not the South at all, right? You've
Yeah.
been where I live. I was actually incredibly impressed with the cell connection the entire time. Now, I was mostly on the
Yeah.
highway, but I mean, I had 5G in these incredibly rural areas, which was, to your point around the potential for mobility or not needing to move, even. The access is there to those who can afford a cell phone and an internet connection. To your point on mobility, though, one of the things I think has always gone underrated about the United States compared to, say, Europe is our ability to be a culturally mobile population, right? If you are in the middle of nowhere and you want to pick up and move, you can do it. Yes, someone from Boston is going to have some cultural differences to someone from Michigan and Virginia and California, but it's a lot closer than someone from Greece versus someone from Iceland, right? So our ability to pick up and move, I think, has been a largely underrated part of the American advantage for a long time.
But almost like you're also talking about what I think for I don't want to get into like cultural relativism, but I always wonder in all those things is like the Lauryn Hill line always popped in my head of like skyscraper paper chasing, what are we working for? Like, is it better to hang out at that local gas station in the rural South and have community, or is it better to do
That's
all this
because you
nonsense we do?
think we're all just entertaining anyway. Like you don't even think any of us work for anything. So, when you have that sort of nihilistic view around work life in general, I'm not I think that's a leading question. It
Well, that's
came
all,
up
the only thing I ask is leading questions.
Well, it came up in part of the reason for my trip. There were some family office conversations, and was chatting with someone. I said, I've always had this not interesting view, because I don't want to say my view is interesting, but like the thought I've always had about family offices that never seems to get answered is like, why does this exist? Right? What is the core philosophical purpose for this family office other than someone made an absolute shit ton of money and now everyone seems to want to hoard it like a dragon? Like they're just hoarding their gold like dragons. And it's like, why are you? I mean, I get the family earned the money. And so for some reason, in the way we see the world as Americans, the family deserves to continue having the money. Why is that fourth generation person necessarily the best person to have that money? Like, why wouldn't it be better if that first generation's person just spent lavishly and circulated the money? Why should we assume the fourth generation person should work at the family office doing private equity deals? Is that a better use of the capital? I don't know. I'm certainly underqualified to answer that, but I often sit there and I go, what is this for? Like, other than, and they all say the same thing. Every family office, when it gets to multiple generations, says the same thing. It's not our money. We're just stewards. We're just stewards. What are you stewarding it to? Where is it going? What is it for? Like, and I'm sure any of my family office clients are gonna be really pissed at me for saying this, but to me, it's like I fundamentally don't understand when people say my goal is to make generational wealth. I want to, like, you and I both have friends who have that objective. They want to make generational wealth, that their kids can work in their family office. And I'm like, what a great way to steal autonomy from your kids. I get that you want to set up your family, and maybe it's like this late stage capitalism. Let's get as much blubber off this bitch before it all explodes type mentality. But I just sit there and I'm like, I don't know why we sort of accept that a family, someone who 100 years ago sold a business and made a shit ton of money, like why the fourth generation has any insight into how this money should be utilized.
Well, luckily in America,
That's my rant of the day.
Yeah.
I'm sure I'll be fired by all my family office clients now.
No, I can't wait to piggyback on it. Is as luckily in America, the third generation usually blows it. It's that trope. You can't really, because it's like it's a weird thing. Like you're saying, it's just like hanging on to money. And I remember, looking at it over the past, is like people get more and more conservative, and then the money dwindles and dwindles as you add more and more dependents onto that list as you get into the third and fourth generation. Then infighting, they'll break it up anyway. And then, as we both know, it's hubris from the initial founder, right? It's like writing a memoir or creating a family office is like, I want my family to, manage this wealth into perpetuity. And it's like you're basically saying you want your essence or ego to go on for your future generations to come. My favorite quotes, I think it's like maybe no, I don't think it's Seinfeld, but it was fly first class because your grandkids definitely will. And so like how it just gets burned through over time. And one thing when you're talking to family office was that first generation decision maker that took all the risks. But like you said, you start getting third, fourth, fifth generation, or just the people that their job is around there. They're not even related to the family. You get into some really weird spaces sometimes about how that money's being managed.
The people who work at a family office, to me, it's like working at another investment firm. I'm not sure that's as big a deal to me. To me, it's always like, at least with most of investment firms, there's a defined objective. We got the help coming back in. There's a defined objective as to what that investment firm's trying to achieve, right? And we have a sort of a split up financialized system where you have asset managers who are very explicitly trying to manage money for a reason, advisors who are trying to help clients through retirement. But when you get to a point of escape velocity with having so much capital that you're not even going to scratch the surface with your spending, and it's going to be multi-generational capital, I just think there's an interesting question of like, what's the why? Right? To me, I don't, that's not to say there can't be whys. Like there are people who would say, I want all of my money to be used for educational gifts, and I want it to last as long as possible, giving away at least this much per year, you know? And great, like there's a core why as to why that money's being used, but I often find like most family offices don't actually have a core why. It's just like we all got really lucky, we won the sperm lottery, and no one wants to mess this up.
Which is kind of awesome. At the same time, it's like you don't like using the word entrepreneur for what you do. You say you're like a biz owner or whatever. But like, I'm curious to like how you deal with the dichotomy of like, most of the time I hate like the rentier class, right? That's just sitting there clipping that coupon that somebody took the risk for in previous generations. What is it like? You're the quote that David Senra loves from Game of Thrones, like somebody in your past history was a cutthroat, so stop acting so genteel, and or maybe you become much more like pusillanimous or lily livered, over those generations, and you're like a veal chop. But I can't remember generally. Oh, where I was going, the rentier class is like, so as an entrepreneur, I love to build businesses, love to do stuff. But at the same time, if I'm having a bad day and I'm sick and tired, I'd love to be part of the rentier class. So I spend half my day just going, I'm never going to be part of the rentier class. Screw those people. And then the other half of my day going, man, mailbox money would be pretty awesome. I'm just wondering like what you go through internally.
I don't know. I never think that way, but I also think to myself, the like time in which I was born, where I was born, the family I was born to, like educated parents who did well for themselves, were able to pay for my education and instill certain values in me. Like I think in many ways, compared to many other people, I already started, on third base, if not on the way home in life, just the day I was born. So it's hard for me to say I'm not part of that class in many ways. No, I'm not getting a check in the mail from a family trust, but to get out of college and grad school without any debt, right? Like that's a huge advantage versus many of my peers. Like that's like getting written a check for several $100,000 out of the gate. So I don't know. It's a tough one. I think it's just hard not to look at all the ways in which you get lucky in life. I don't know, but I'm not going to be a multi-generational money steward personally. So
The other, I plan, what is there's like several people said I want my last check to bounce or something like right before I die. Like that's such a good one. But so part of your road trip, I'm curious is like what I love on road trips too is like looking at like all these local or regional businesses that you see like by the side of the highway or whatever. And then I just imagine like what kind of like what kind of revenue they're doing, what they do, like how long they've been in business. Like I just would get really curious about like all the businesses along the side of the highway on that road trip. Is I can't help my latent curiosity with entrepreneurship and business. So I'm curious like if you saw anything on your trip, but like the logistics of the Kentucky Derby were blowing my mind. Because like nobody wants to go to Louisville outside the Kentucky Derby. I know some people are going to argue, well, they do these other events throughout the year, whatever. They're trying their best. But no, it's all about the Kentucky Derby. And for like basically 4 days a year, if you're a hotel, that's one thing to deal with this crazy influx and how do you manage, that, and then how do you deal with your room rates throughout the end of the year. But
how do you
I was
staff
just
up and staff down?
staff up, staff down. But then you start thinking about all the ramifications of that, like all the drivers, right? Because like most of these people have like either vans, buses, or like private drivers that are driving them to and from all these different events that are going on. And so I started asking around because I'm just curious. And it's like, typically for somebody to do that professionally, right, they need their CDL, they need the commercial driver's license, right? So you can't just get like a local Uber driver or something to do this. So like people are coming in from Indianapolis, from Nashville, from Atlanta, from Washington, D.C. So they're bringing in all these people that have CDL licenses. But then now you have a car problem, right? You're not going to sit on that car inventory, that van, that bus inventory, that black car service for the rest of the year. So now you have to bring in the cars from all of these nearby, cities and towns. And you're bringing these all in for like this 4-day event. And then obviously the Derby and Churchill Downs is absolutely insane. And then, yes, they have races throughout the rest of the year, but there's nothing that's the equivalent to this. And what I found primarily is the service, understandably, absolutely sucks. Like you're going to like all of these like food places or whatever, like even in hotels or at the track or whatever. And because it's just looking to throw bodies at the problem and temporary staffing is like, I remember because one of the days was Cinco de Mayo. So I was like, oh, I'll have like Herradura was one of the sponsors. So I was like, oh, I'll have a margarita. Worst margarita I've ever had in my life. I don't think the guy's ever bartended a day in his life, but it was just like throwing bodies at the problem. And it was kind of fascinating to just think about all of the logistics, all of the business that goes into just putting on an event like this. But I have some, go ahead.
Yeah, no, I think I just want to pause there because I think there's a really interesting question, which is how much slack is in the system in terms of quality, right? Because does that bad margarita change the fact of like whether you're going to go to the Derby again or not? Like how shitty can it be versus the event more than makes up for the lack of quality of labor, right? And there's so much from the logistics side of getting all those bodies involved. The big ROI question is there any benefit in training them better? Like if that person made a better margarita, does it change the profitability this year? Does it change the profitability next year? Right? I don't think it does. I think there's a certain amount of like lack of quality you can get away with in those sort of events.
I'm trying to think if I'm at liberty to discuss like how much I found out the tables were going for and everything. And if you start talking about those prices and you're like, you can't even make a decent margarita. But so to your point,
people buying the tables, are they buying it for a decent margarita? Or are they buying to say, I got a table, look at me, right?
No, they got a table. So that was interesting. The tables, we were in the Matt Wynn Steakhouse, which is on the 6th floor. It's right over the very top of the Kentucky Derby. We're looking right down the finish line. It was an amazing experience. So you get inside, you're in like a steakhouse inside, and then outside you have your own viewing area. Like it was totally like an absolutely impressive event. But what's interesting, those tables are on a 40-year lease. Like you have to buy those tables on a 4-year lease. And we were guests of one of the owners or owns several horses in the event. And we found her owner's box is on a 40-year lease. So she had 40, had to book it out 40 years. Yeah. And so you could start imagining, some of these costs were just astronomical. But one of the things they did that was really smart.
How's her family office? What's she doing it for?
I don't know. That's a good question. I don't know how they run it. So we were guests of Kendall Jackson wine family, and they also happen to own one of the biggest breeding farms in Kentucky as well. So their two primary businesses are obviously the wine business, and they own over 40 wineries. People don't realize they have luxury brands all the way down. And then they have this whole horse business too on the side too, which is incredibly, I think they do pretty well with it. Like I said, being one of the largest breeding farms in the country. But what's interesting, like we were saying about staff wise, this was brilliant. They brought their own master sommelier that's on the staff at Kendall Jackson to work that steakhouse. And then, so they had their tables in the steakhouse of their guests, and that sommelier is working those tables. But then they also feature their Kendall Jackson wines on that steakhouse wine list. And if anybody orders a Kendall Jackson to their table, that master sommelier comes over the table, opens it, talks about the wine. And I thought that was a brilliant way. Because like otherwise, yeah, like people could have had a terrible experience with their wines at this event, even though they're paying this fortune to get these tables.
That is pretty brilliant, and a good way of like, I don't want to say turning it into an investment of sorts when you're talking about buying that table. But I have to imagine if you're breeding horses in Kentucky, it's kind of important that you have a presence at the Derby, right? Like that 40-year lease all of a sudden makes a lot more sense to me if you're a well-established business in that space. Like that might be a very key investment from a brand perspective.
But also, it's obviously key investment. I mean, it was all the things from even at we stayed at the hotel that was like the sponsor, like the main hotel of the Derby, and she had all of her flags outside for like Kendall Jackson families, for Stone Street Farm. Like, I mean, it was just like huge, like marquee sponsorship and all that stuff. Obviously, is part of the branding exercise. But even in the comments, John Weiland said it's a deductible business expense. My question is, it really like, because I thought that whole change of T&E, maybe if it's different if you're running horses and you're an owner. But like, remember how like the sports teams used to be able to buy boxes and everything, and that was the deductible business expense, but it's no longer. It's just the food and drink, and that like changed those dynamics tremendously for those stadiums.
I didn't.
Do you have any idea?
I've got no knowledge about that. Unfortunately, I haven't gotten to that level where I've considered buying boxes for my business.
There's no Newfound research. Could I suggest Newfound research gets floor seats at the Sixers games, and then I can go as a guest of Newfound research.
Yeah. Easily write that off.
How many states border Kentucky?
Oh God. Why would you quiz me like this live?
Why wouldn't you tell me to
pull up a map? I don't know.
Public map. It's 7. So that was interesting. So like we're sitting there too on the Louisville side, looking across the Ohio River at Indiana. So you have, let me see if I can go through this. You have Missouri, Illinois, Indiana, Ohio, West Virginia, and Tennessee. Did I get that right? Probably right. That was one of, a lot of states. And it's interesting to like be in a state that doesn't really have a sports team. You have the University of Louisville, like obviously pretty, decent college sports. But we were always wondering, it's like, do they have their professional sports team? Do they lean towards Indianapolis? Do they lean towards Nashville? You know,
Right.
Pittsburgh's not terribly far away. Like, you know, like who do they kind of root for on the professional team sense? Next trivia question is, Kentucky is a commonwealth. What are the 4 commonwealths in the United States? Come on, you should know that. You should know another one. Another one's easy for you. You don't like trivia games when you're growing
Commonwealth
up?
of Massachusetts is what they always call
Exactly.
it.
Exactly. So that's 2. There's 2 more.
Commonwealth of Kentucky. There's 2 more commonwealths, really?
Yeah.
I don't even know what a commonwealth
doesn't mean anything.
is.
It doesn't mean anything. They're just trying to be fancy. And so that's why they call themselves commonwealths. But the 4 commonwealths are Kentucky, Massachusetts, like we said, Pennsylvania, and Virginia. So there's 4 commonwealths that are like go by states.
And it's just a meaningless thing.
Yes, it's totally meaningless. Like, it doesn't make any difference other than they think they're fancy. By the way, that did just remind me, what's the longest state name?
What? Where is this coming from? Longest, wait, hold on. Longest.
I'm a font of worthless information. So yeah, what's the longest state name
in terms
technically?
of?
And you're a New England boy, so I'll give you a hint.
Letters.
Yeah, I'll give you New England boy. You're a New England boy, so this should be.
Well, I want to say Massachusetts has got to be up there. Connecticut. I have to actually think through my head which one's longer.
It's a trick question. So the actual answer is, the technical name for Rhode Island is Rhode Island and the Providence Plantations.
God damn it.
Don't ask me where I've stored that up my asshole. But the other, okay, now getting back.
Is this now a trivia show?
No, it was just random, trivia that I thought I would, when in Kentucky, you're at the racetrack, there's not a lot to do. Maybe I'm just looking stuff up in between.
A lot of people would presume Jason went to the Kentucky Derby. I bet they're going to do a show about sports gambling, Kelly betting, interesting horse racing, hedge funds. No. We had so many opportunities, and here we are.
I'm glad you led me into that, though. What I did look up, it looks like this year they're expecting about 400 million was wagered on the Kentucky Derby. Yeah, I was picking a brain after. We had a relative that works for Churchill Downs, and I didn't know they owned like 14 casinos across like the South and Southeast and a little bit in the Midwest now they're going into. But it was interesting kind of diving into and all the data they're starting to use, to like track customers, all that sort of thing. But yeah, about 400 million. And then speaking of waging on horses, as you know, it's pari-mutuel. And so their VIG is like 13%, I think. And so, which is another reason why you shouldn't bet on the ponies as well, is like the hurdle rate on just the VIG alone is enormous.
Yeah, that's a big spread. So who do you think is who are the big winners, right? And who do you think the surprising losers would be in the business ecosystem around the Kentucky Derby?
Well, obviously the casino is the big winner. The big winners and losers, like are you thinking, like the state and state revenues and hotel like TOT, like hotel taxes?
Do you think like the hotels like actually end up being big winners? Do you think the local restaurants end up being big winners? Like, do you think it drives enough local business, or do you think it ends up just actually being a disaster for them?
I think it's a huge money grab, and they think, this is what drives both of us nuts. I bet they look at top line revenue and go, wow, we crushed it, and everybody touts those numbers. But like you said, then what's the actual net, and how do you amortize that across the rest of the year when you have no visitors? Like, I bet it's really tough. And like, yeah, I'd be very dubious to the people that are saying they're winners. Obviously the local community around the race that's charging $50 to park in their yard. It's a pretty good weekend for them. Yeah, really pretty good weekend for them. I did tell you about these. I went to one of these gala parties, and it was crazy. Like, walking in is like, it was just it was a nice reminiscent of the 90s, right when I walked into the party, I'm like, man, that sounds like Boys to Men. And then I turned and looked, and it was actually Boys to Men on stage, and it was just like,
that would have made me so happy.
It made me so happy. And I am a simple man. It was just Boys to Men was unbelievable, but it was just like all these hits from the 90s basically. And it's, I guess, understandable at a Kentucky Derby, Kentucky party. But yeah, it's one of these big events. But like, you'd be surprised by too, which is kind of shocking. It's like, when you pull up, I guess there's not a lot going on in the area, and this party's like at a mansion in this area of mansions. Like, it's very, very like nice part of Louisville. But when you pulled up, there's like there was people like 10 deep on the hill across the street, like looking to just see celebrities coming out. And it's not like, I mean, it's Kentucky. There's some celebrity, but there's not like massive celebrities. But it was just fascinating. Like, and so the locals were telling us like this is a huge thing for like the local scene. Like this is their
Celebrity
Oscars, right?
watching.
Yeah. Like so you're saying like, but it was
Interesting. All right. Ready for a little change of subject?
Yes, please.
A little change of subject. I did a little Twitter bomb right before this
Uh-oh.
with my engagement hacking. So here's an open question for you. Total change of subject. We're going to talk about portfolio math here for a second. So everyone who's more interested in the Kentucky Derby can tune this out. But actually, last thing I'll say about the Kentucky Derby, if you can get a picture of Jason from the Kentucky Derby, he was looking fancy. I am not allowed to share what his outfit was, but he was looking fancy. I would urge you to try to hack his cell phone for those pictures. Okay. I want to talk portfolio math with you. You run a portfolio. You probably get benchmarked to something, right?
Yeah.
If I said to you, I want you to plot your cumulative excess returns of your portfolio versus that benchmark over time, how would you do it?
Like, how does everybody do it? They just take their annualized cumulative return over time, and that's what they use, which is, by the way, my least favorite metric by far. But why do you bring that one up?
So the excess return of the portfolio versus the benchmark, though.
Yeah.
The excess return. So you're saying they take their cumulative return annualized?
I think most people do annualized, which drives me nuts instead of doing Kaker. And then what they do that every time you see it, drives me crazy is like cumulative returns 800% and the market's 500%. And it just drives me crazy.
Yeah, but how do you, so over time, so what you're saying, plotting it over time, they would take at any point in time the cumulative total return and subtract the cumulative total return of the benchmark.
Yes, I believe that's how most people do it. And I, as you know, would always use Kaker, but I don't even think people are using Kaker. I think they just get lazy and annualize it and then subtract, right?
So this came up for us internally as to this is something we wanted to plot. And it seems like a very trivial question. Like, how do you like cumulative excess returns? That's not hard. Just take your returns, subtract the benchmark returns, plot them over time. Here's the problem as a naive example. Let's say you have your portfolio and your benchmark and you start them at a dollar each. On day one, the portfolio goes up 100% and the benchmark returns 0. And then every day afterwards, they both are positive 1% every day. If you take the total return of the portfolio minus the benchmark, that line will be positively sloped. Because what happens is that 1% every day afterwards, even though the benchmark's also earning 1%, it's 1% on a higher amount from that compounding amount from that initial 100% gap. And what I would argue is, well, you're actually returning the exact same amount every single day after. So why are your cumulative excess returns actually going up? Isn't it more telling if you're trying to plot something like this? Like, to me, what I'm trying to show is, did you outperform the benchmark? Well, other than that very first day, no, you didn't. I would think that that line should be a flat line, right? But it's not. The way you said, hey, take the total return, subtract them, plot them, it would not be a flat line. Other people argue, well, that actually is the cumulative excess return from the beginning. To me, it's only a cumulative excess return for someone who invested day one. Someone who invested day two actually has been totally flat versus the benchmark. Okay. So what's the other option? Some other options I could throw out there. You could take the ratio. One way to solve this is take the ratio of their returns. So if, it's $1. They both started at $1. You take the ratio. It's at $1. The portfolio goes to 2. The underlying's $1. Great, that jumps up, and then every day after, as you take the ratio, it becomes a flat line. So the ratio shows the relative return. Problem is the ratio is not investable. That's not a return stream you can actually achieve. Okay, so how do I turn this into a return stream I could actually achieve? Well, another way of doing it is saying, what I'm going to do is I'm going to look at their daily returns and take the difference. And then I'm going to compound that over time. It's a third way of doing it. What that effectively is doing is saying, I'm going to go long my portfolio and short the benchmark and rebalance daily. I think that's reasonable, but it brings up a question of, well, why not rebalance weekly? Why not rebalance monthly? Why not rebalance annually? Other than the rebalance timing luck of it all. That daily compound will actually have an impact on the cumulative return stream versus if you did it weekly or monthly and allowed them to drift versus each other. By the way, once again, I throw something out on Twitter and people answer me with such unbelievable certainty. I am amazed people give me a little bit of credit that I've thought about these things a little bit. And if I'm asking what seems like a very obvious question, consider maybe it's not a very obvious question. Or maybe you're listening right now and saying, Corey, you're an idiot. The point I'm trying to make is something as simple as how do you plot cumulative excess returns? I think is a very non-trivial question.
Yeah.
And I think there's a bunch of these in finance that we spend so much time thinking about complexity that even something as simple as this actually goes very overlooked. And if you ask people to really seriously think about it, they kind of get themselves lost in circles, which I have, by the way. I don't think there's a good answer. I think it very much depends on what you're trying to show. I think 9 out of 10 times you should probably just plot the relative returns, like the ratio, and call it a relative return stream. But you have to acknowledge that's actually, that return stream is not what is investable. What it's more showing is the relative growth rate of the portfolios.
Yeah, this is one of my favorite subjects, at least tangentially too, about how averages lie and hide things, and the maps are not the territory. And we're delving right into the world of ergodicity, because what you really got to the point was, it actually matters what that individual return is, and who cares about the return of the ensemble over time. And as we've talked about many times, like ARC and everything is like, on a dollar weighted basis, like most people are going to lose money on ARC. That's just an inevitability of the flows of funds coming into ARC. And what people actually only care about is their return. And then, as much as I said, I even love Kager, Kager can be gamed just like all these other things can be gamed. Like, as we've seen a million times, if somebody spins up a hedge fund and the first year they're up 50 to 70%, and then the next few years they're, right around like 1-2%, their Kager is going to look great for a few years until like the law of large numbers works it out. But that's what they're going to market off of. And so you're really hiding that event within the Kager structure. So you have to be very careful and wary of these things. And like you said, what's even crazier to me is, like you're saying, is like not only how hard these things are plot, like how would you try to rationally, or in a way that makes sense, like project your cumulative excess returns. It's even shocking to me is how many people that have brokerage accounts at the large wirehouses where they can't even figure out what their own personal glide path has been. Right, like it's surprisingly difficult. Like if you ask anybody, like what's your
actual wirehouses?
Yeah,
I go to Schwab or TD or any, like the RIAs, the custodians. Like it is non-trivial if you're putting money in, taking money out. Like I think it wasn't until last year someone like Schwab on their platform really actually was able to account for some of that in their reported returns, in their statements. Like that's all very non-trivial stuff. You have to consider like the compounding impacts of that on your portfolio return when you take it out.
And then to take this even like a level deeper into nerddom, as I was reading this morning, a great like multi-part essay by our homie Chris Abdul-Masih when he was talking about variance time. Have you read this at all?
Oh, loved it.
But like, I mean, it's only, nobody would really care about this. Like he's saying, you could use dirty variance for most people and they're just fine, right? But the idea was with variance time, where people used vol as a metric for variance, but it's really just variance. But it matters, are you using calendar days? Are you using business days? How is that accounting for weekends? How should we readjust our theos to figure out what variance time would be, where you would take into account weekends, but then you also take into account maybe FOMC meetings or everything we've seen lately with zero DTE options. And the whole idea goes back to me of Chronos and Kairos, back to the ancient Greeks. Chronos was clock time, and then Kairos was like the opportune moment. And what we talk about a lot in option space and vol land is time speeds up, slows down. And so if you're trading implied volatilities off of calendar time versus business day time on the annual basis, you can have very different implied volatilities, even though you're trading the same price. And so it just starts getting into then, then if you are going to blend the calendar and business times to a variance time, as he was suggesting, but then what kind of handicap or not do you give to those very auspicious days of like FOMC meetings or CPI that we've seen, and like how much those matter in the last year per se? But like, how do you weight those and create your own theoretical framework for that?
Well, especially because for most of the mid 2010s, those meetings didn't matter. Right? There were years and years in which it was like, no, we just know the rates are staying low, right? So all of a sudden you have to go, historically, I could have weighted them at zero, not zero, but like it was an average business day, versus now they are much more of a profound impact in other economic news. Now, that's all because of the Fed reaction function, Jason, which I know is your favorite. The other one that was getting me on
Fed
my
watcher.
trip, the other one that was getting me on my trip, speaking of vol, was like people just using VIX as shorthand for vol. And it's become so, like, whenever I hear that now, I've just got Ben Eifert from QVR ingrained in my head going, VIX is the 1 month strike of or the strike of a 1 month forward variance swap. I'm like, and a variance swap strike should not be what a vol strike is, because there's a convexity embedded in the vol that's not in the variance. And it's like, oh God, like every time I hear someone use VIX as shorthand, I'm like, I hope you know it's shorthand. I hope you're aware it's shorthand, but I'm not 100% sure you're just being dirty for the sake of we're just having a fast conversation, or whether you actually think that's the meaningful thing you think it is.
Yeah, I don't even want to head down that road because it just makes me angry whenever anybody brings up the VIX in general. But it did remind me, on your road trip, what do you listen to? Podcasts? Do you listen to music? Do you listen to books? What do you do?
This is actually
silence.
This brings up a great conversation, Jason. Thank you for that. I know you didn't mean to do this. I was catching up on one of my favorite podcasts, which is Dean Kernut's Alpha.
Oh, here we go.
Exchange.
This is on my list. Yeah.
And I was catching up on his conversation with Roni Israelov from Endeavor, ex AQR, head of the vol desk there. And he was actually talking about a paper I co-authored with him, which was fun to hear someone else talk about a paper I co-authored. He explained it infinitely more elegantly than I could. So I think just he's going to be on the circuit now talking about the paper rather than me ever talking about it. But that was a lot of fun for me, hearing about rebalance timing luck and the paper we co-authored. But you sent me a question afterwards that I think is a fertile ground for question and debate, which is Roni. One of the things he did at AQR was build out their vol risk premium harvesting strategies, largely multi-asset, so across rates, commodities, currencies, and equities. And he has written some papers about the difficulties of tail risk hedging. And one of the conversations you and I were having was, can you believe that there's a volatility risk premium you have to pay in tail risk hedging? So it's negative expected return from a linear perspective, but it allows you to add more leverage to your equities, and that extra equity risk premium more than offsets the drag from the volatility risk premium or variance risk premium. And or can you overcome it with the compounding effects? I think the first one's interesting just from the pure linear perspective of, okay, I'm adding some equity risk premium and then I have to subtract some variance risk premium from what I'm hedging. But then I think that it gets more interesting when you talk about the compounding effects. You and I went a little bit back and forth on a text rabbit hole, but maybe you can tee it up even better than I explained it in terms of what the core question was.
Well, maybe not better, but I'll say it more simply, because maybe I wasn't paying close enough attention, and as per usual, I was listening at 2x speed, and I think I was getting my last hit of Chick-fil-A, so I might not have been paying close attention because I was getting that sweet fried chicken. By the way, always go double fillet on the patty. It's the perfect fillet to bread ratio. But and shout out to Dean Kernut, Alpha Exchange, one of our favorite podcasts, and it's great having Roni on, which, as you said, is one of
Can I just say, sorry, one thing I want to add. Alpha Exchange is the podcast that Flirting with Models would be if I grew up. If I didn't stay Peter Pan and I actually took my job seriously as a podcast host, that's what it would be. But instead, I just do increasingly psychedelic podcast covers, and surprised guests even come on anymore.
And then Roni is one of the 5 people along with you and I that actually care about rebalancing timing luck. So we're obviously biased here. But one of the things what I brought up with you, and maybe I don't want to misquote or misattribute this to Roni, and maybe it would be better if he was here. But he was basically talking about, you have basically 2 hurdle rates, the ERP and the VRP, when you talk about hedging. And he was talking about having that reduced equity exposure of like 60% equity exposure. So you're lessening your capture of the ERP, and then then you have the headwind of VRP. But I don't think he said like, well, you could up your exposure to ERP in that scenario. And that was my question. Then you subtract your VRP, and like, where do you end up?
Yeah.
But then the other thing that you started getting into, which I say I deal with often, is like the linear cost versus the convex returns and the portfolio effects.
Yeah, so I think there's 2 things here. So what he was talking about very specifically was a lot of these put spread strategies, right? That you are buying, call it a 95-80 put spread, you're selling the offsetting call that will make it a zero cost structure. That inherently brings your portfolio beta, if you sort of beta-ized the delta you're getting there, below 1. So I think the point he was trying to make was, look, when you do that, yes, you are downside hedging. And actually that structure is short vol intrinsically. So you're actually capturing some positive vol versus premium.
Which I appreciate that he says, yeah.
But you're giving up some of the equity risk premium, because even though you might be long underlying beta, the delta in the options is offsetting it. I think to your point, right?
No, that was good though. Like, no, that was a good counterpoint. Like, yeah, if we were talking about essentially put spread collars, it's like you're reducing your beta. But
yeah,
so sorry,
and
I just
so
wanted to
re-highlight
that.
And
yeah.
I think to your point is, well, that's fine. You don't have to reduce the beta, but though you could buy some equity futures, right? And neutralize the delta component, in which case you now have your full beta, you've neutralized the delta component, and you're just short the variance risk premium.
Right.
In which case you're getting, right, arguably beta equity risk premium plus variance risk premium. And you're taking whatever sort of risk, non-convex risk that comes with the variance risk premium, right? I think it gets more complicated when you say, well, what if I just want to buy a pure downside put, right? So I'm explicitly paying the vol or variance risk premium. I never know which one to call it. Variance risk premium, I guess. But you're gonna, because you have that downside risk capped, you're gonna say, I want to run my equity hot. I want to buy 120% notional or 130% notional, knowing that I've got this tail risk hedge. Right? Would you expect that to outperform just long equities necessarily? And I think that's a complicated question. Like, should that variance risk premium that you're paying be expected to offset whatever equity risk premium you're taking on?
Right, and that was exactly the question I was texting you about, which is great, because that's what I think most people miss is, if there is ERP, you could run your beta exposure a lot hotter if you have those hedges in place. And then the question of where do you end up ahead is, that's a time sequencing risk scenario. And then once again, ergodicity gets involved on the rebalancing effect across your portfolio. But I think most of the time when these things are talked about, is people don't think of that they could run their beta even hotter. And so I think a lot of people miss that.
So I think there's I'm going to assume we're not delta hedging here. Or are we delta hedging?
Yeah. Or sorry, let me finish another thought. Sorry, before we get into the delta hedging aspect of it, is like, the other thing I think about is like, okay, let's say I end up in the same spot. This is also kind of what I was texting you about. Is that if I buy that put protection, I end up maybe in the same spot as running like it's going to look like a similar beta to running like a 0.6 beta, right? Like running 60%, long S&P or long SPY. Okay, but I have an unknown left tail to my SPY position, where if I'm buying tail risk protection, I know I can truncate that left tail, assuming monetization heuristics, etc. And to me, it's like, if we end up in the same place, wouldn't you rather that insurance and that peace of mind and sleep at night? I mean, I'm kind of leading the witness here, but like,
yeah,
I mean, just running a lower beta to equities.
Theoretically, those things shouldn't happen, right? You shouldn't be able to say, I know with certainty, and we end up in the same place. Like, you might end up in the same place ex post, but ex ante, you shouldn't be able to end up in the same place, or else you have an arbitrage. So one of the questions I would ask is, let's say we're doing the tail risk hedging and we want to take a little bit more leverage in our equities. that tail risk hedge that we're buying, is it offsetting the full notional? So for example, if we say instead of buying 100% equity, I want to buy 150% equity. When I buy that downside tail hedge, is it for the full 150 or is it for less than the 150?
Right. And that depends. And if you're doing 100 or 150, and then what attachment point are you using? How close at the money or how deep out of the money? Now we start to get into a lot of the nuance that's going to create variability.
The deep, like there's some conflicting stuff of like at the money or deep out of the money, because then you start talking about the delta impact. So I'm going to assume it's actually a delta hedged option just to make my life easy, right? So we're ignoring the beta effects. The point I'm trying to make is I shouldn't just be able to buy any amount of equity and then get a downside put protection that gives me the notional that covers the full notional and expect to have paying that variance risk premium and expect to get the full equity risk premium. Like I should be paying something for that. I've clipped a path of all the potential future paths. I've gotten rid of some risk. My expected return should go down. Now, where this gets more complicated, right, is, and I know this is where you want to jump to, is like the linear expected return may go down if you can believe that you can monetize that put at the right time and reinvest in equities in a conditional way where the rest of the market is being forced to liquidate and sell. And so you're able to buy at an elevated premium, like the market is not behaving efficiently, then you can compound at a higher rate with that structure. But there's a lot of conditionals there. If you believe the market is largely efficient, like you should not just be able to say, let me get rid of some risk and I'm going to end up in the same place or better. You have to end up in a worse place or else there's an arbitrage.
In an efficient market hypothesis, absolutely. And I was just thinking about when you're talking about it is, I agree with everything you're saying. Like you said, there's so many conditionalities here. And then that rebalancing timing luck too is like, that's also how you choose like how much delta you are going to protect or how close to at the money or, you know, or at the money or out of the money you're going to be. Because if you can rebalance more frequently, right, you can reduce your rebalancing timing luck. And it's potentially like, right, then you have the conditional probabilities of like, how often should I rebalance? Do I end up net ahead or not? Right. And how large is that sorry, you would call it diversification premium, not rebalancing premium, that you could extract from that, allegedly. The other thing though is like if ERP and VRP exists, right? How do you think about the correlations between the two? And so, for example, it's like right when you're getting negative ERP, you're going to be experiencing negative VRP most likely, and that's when you're going to desperately need the convexity of those tail risk options.
Well, I think Roni talked about this, and I think it's a great episode. I think it's a great podcast. Everyone should listen to Alpha Exchange. But I think Roni hit the nail on the head. Is like there's a very non-linear part, right? You're harvesting the VRP, but you're taking a non-linear risk. Whereas with the equity risk premium, it's a very linear risk.
Yeah.
Now, you might argue it's not linear. Equities are a call option on the residual assets of a firm, Merton model, blah, blah, blah. I think at the aggregate index level, it's a pretty damn linear risk at this point. So there's just very different behaviors in terms of the payoff of the risk versus the expected return. And that's arguably why the variance, like you need more expected return in the variance risk premium because there's a convexity element to it that you need to be compensated for. But yeah, it's a very complicated topic.
Well, it's like you started with, if we can't figure out what's your cumulative excess returns and what's a reasonable way of doing that, and then the moments we start talking about volatility squared, over implied versus realized, like it's just we're getting into
the takeaway, if I can impart any wisdom, is like whenever I think about these problems, and I know we've probably lost a good half the audience who doesn't like thinking about this stuff, but I always start assuming the market's efficient. And it doesn't mean I believe the market's efficient, but I think it's a strong foundation to start with because I can reason through what should happen under that theoretical condition. And then I can start to relax those assumptions and say, well, where do I think the market's not efficient? Right. But like there shouldn't be free money out there. You shouldn't be able to just say, oh, actually, if the market's efficient, I can buy some more equities, buy a downside hedge, and be better off in all conditions. Like arbitrage should not exist. And so once it gives you a very solid foundation to start thinking through some of these questions logically, and then you can pick and choose how you relax it based upon your own personal beliefs. And I get a lot of pushback on that for some reason. Like I always say to people, start by assuming the market's efficient, and they go, "Oh, the market's not efficient." I'm like, I don't care. Like, let's at least logic through this from a foundation of efficiency, and then we can selectively, sort of move on from that.
No, I'm glad you fleshed it out again because I appreciate the way you say it. And what you're saying is like you don't necessarily believe in it, but like the onus of evidence is on the opposite, right? If you believe you found an inefficiency, like you have to have on the presumption that they are efficient, and so you need to really prove that out that you found this inefficiency. Can they be found?
Right.
Yes, but the likelihood that you found one is a lower probability event than you likely think it is. So that's where people get stuck. And I think I always appreciate the way you said. There's two small things I want to tie in here at the end. One, because it came up in the comments, Scott asked, what's optimal leverage for SPY on its own? And I think you've talked about this many times about like kind of overlaying Kelly criterion over SPY and how much that can change over time. So once again, like how could you,
so this is actually a really fun exercise that I think anyone can do in Excel, right? So what I would do is you can download the returns of SPY, download the returns of T-bills or something like that, and just find the monthly returns. And then what I would do is I would take the monthly returns of SPY and subtract out the monthly returns of T-bills to get the excess returns. And then what you do is you just have a whole bunch of columns and you multiply that by 1, those excess returns by 1, and you come up with a cumulative return series. You multiply them by 1.1, by 1.2, and you just keep going up. And when you get to sort of the higher numbers, what you'll find is if you plot the compound annualized growth rate of those different time series, it'll go up, hit a peak, and then start going down. And that peak is in theory ex post the optimal leverage level. It maximized your compound annualized growth rate, not subject to any risk limit, by the way. I bet if you look at the return stream, there's like a 90% drawdown in there, but ex post it maximized your compound annualized growth. Those points to the left are those where you didn't take enough leverage risk. The points to the right are where you took too much, and those drawdowns negatively impacted you and you couldn't compound your way out of them. So it's a really fun exercise. Then what you do is you go, let me look at sub-time periods. So instead of looking at the full 30 years or 50 years or whatever data you have, you do it over 5 years, and you will find that the optimal number is very, very different. Because there are 5-year periods where the optimal number is to have no leverage. In fact, the optimal number is to have no SPY, right? That's when the S&P lost money. And you start to like gain, I think, some intuition of what is optimal over the long run, potentially, versus what is survivable in the short run. And this is why people end up so far left of the optimal Kelly number, because it needs to be behaviorally survivable in the short run. And it needs to be, well, yeah, I guess it just needs to be behaviorally survivable in the short run. Like what's optimal in the long run is not necessarily what's optimal in the short run.
Yeah, and to layers of the timing, once again, it's tying back to what we were talking earlier. Is like you're talking about the cumulative returns and how many people just use analyzed returns instead of CAGR. And then people can look at sometimes monthly returns, but we always get daily returns from our managers as well, because that's where the drawdown's hidden, right? Like you probably want to double a monthly drawdown to figure out what your daily drawdown is.
Yeah,
like
I mean, go look at the monthly drawdown of March 2020 versus the daily drawdown of March 2020, right? I mean, that you got a huge rally in the last week and a half of March 2020 that makes the monthly return look way better than what the actual intra-month drawdown was. Same thing happened October 2016 or something like that. You had this massive sell-off mid-month that completely V-recovered by end of month. It ended up being a completely flat month, but intra-month, the market was down. That might have been October 2015. Maybe 2016. That was just, again, if you're using monthly numbers, you're underestimating the risk that actually happens.
There's one thing I want to tie back in. We're over time, but it'll be quick. Is when you were asking when you were driving through the South about where are they at the bullwhip? Are they the front or the back end of the bullwhip effects, right? And I was thinking about, and like you said, we're starting to get into global macro territory, and this is why I don't like global macro in general. Is I was listening to a podcast with Hugh Hendry, had Russell Clark on his podcast, and arguably people are, you're not going to call either of them stupid. You may disagree with their views, but they're two very bright individuals who have unbelievable track records as global macro traders. And they were talking about how they were looking at the same data and had entirely divergent opinions. And so what Russell Clark's been banging on about for a while now is his short TLT long gold trade. And to your point, like he's saying that we're about to have a regime shift back to pro-labor policies, and that therefore rates are going to be higher for longer because we're going to have pro-labor policies. Hugh Hendry's looking at the same data, the same charts, the same everything, and thinks that China coming back online is going to be a huge deflationary effect, and he's long TLT. And so these are the factors of like, yeah, and they can structure their portfolios with maybe non-linear instruments where they could, you know, both be wrong, both be right, and both survive and be fine because of what the rest of their book looks like. But everybody likes to look at global macro and then attenuate their entire life savings to like one person's opinions that they're guessing about the future. And it makes absolutely no sense to me. But I love when you can have two reasonable people that have two great track records, two unique ways of viewing the world, and they can acknowledge that they're looking at the same data and drawing, you know, polar opposite, you know, results from it.
Well, I think that's the great takeaway from me there, and I'll have to go listen to that podcast, is how do you structure a portfolio when you have a high conviction view? How do you survive your high conviction view if you're wrong?
Yeah, and I think going back to Drobny's old book, I think it was, what did they call Hugh Hendry's moniker in there? Was like the Plasticine Man or something like that. But Hugh talked about in that about, I have 100 positions on them, like a centipede. So if I need to chop off 10 positions, I don't mind, and I can get out of trades relatively quickly. Where on like 147 hours, is it where you only have 2 arms, you have to chop off 1, is a very different story. And so that was an interesting way that, you know, Hugh used to talk about his portfolio construction was, you know, 100 different positions in very convex instruments and small position sizes, right? And then therefore you could be dumb and wrong and still right and still make money for your clients based on portfolio construction. But as we both know, portfolio construction is one of the least talked about things, I think, anywhere in finance. Like everybody's just talking about their hero trades and never, what's the position size of your hero trade? What's the rest of your book look like? Is there offsetting positions? What's linear? What's convex? And you never really get to see any of that. But related to Hugh Hendry, by the way, was, you know, Hugh is allegedly moving behind Patreon, so you only be able to listen to 25 minutes of that. You know, we've had other friends that are moving to Substack. Obviously we don't have, you know, Booty Crew is amazing, but it's not sizable enough for us to be monetizing or even think about monetizing. But this is going to depress you. I was listening to Will Compton from Bussin' with the Boys, was on like the Next Up podcast, and he started talking about their renegotiated deal with Barstool. And I want to say he said it was $3 million a year guaranteed, and then a 70-30 split of revenues beyond that with Barstool.
Good for them. I guess we're all just entertaining each other, Jason.
Oh, we totally forgot. Speaking of which, our entertainment, our Pirates Pinky Promise. We've been out of the game for a week. We totally missed the Pirates Pinky Promise.
Totally forgot.
Speaking of monetizing this podcast, that's our monetization heuristic. Like, you just have to subscribe to this podcast. We're out here. You know, Corey's driving through the night trying to make it to the show. You know, we need to afford some, you know, paint for his walls because they're hideous. You know, these are the things we're working on to improve the show. But all we ask from you, our Pirate Pinky Promise, is for you to subscribe to the show. We just want to get those YouTube subscription numbers up, so that way we can have some sort of vanity metric that we can use to create some sort of monetization. Why do we do this?
Just having fun. All right. Once again, this is the Pirates of Finance. Nothing you heard clearly was advice. Not tax advice, not financial advice, not life advice, not marriage advice, no advice whatsoever. Seek professional help if you need advice in any of those things. Thank you for tuning in. We appreciate your time. Tyler, take us out.